So the S&P 500 has pulled back quite a bit from the midsummer highs. Even after the recent rally, it is still down about 5% from where it was in the beginning of August. And this has created some interesting opportunities to put money to work that we didn't think we'd have. It looked like the bear market was coming to an end for a while. Before we dive in, please take a minute and click subscribe to my channel if you haven't already, and check out the link you see on your screen for a message from our sponsor, The Motley Fool. You can get the top 10 stocks to buy right now. It's the best way to support this work we're doing on YouTube. So one great place that I always like to look for some inspiration is Warren Buffett's portfolio, specifically what he invests in through Berkshire Hathaway. Berkshire Hathaway has a roughly $370 billion stock portfolio, last I looked. It's a massive amount of investments in there. I want to say there's about 4 dozen different stocks in there, and some of them look extremely cheap right now. The financial sector in general looks very, very cheap right now, and some of Buffett's are some of my favorites right now. Bank of America looks especially cheap right now. It's being treated like it's an unstable financial institution, and that's absolutely not the case anymore. It was during the financial crisis, but now things have changed. Capital One's another one. A lot of people are very pessimistic about the credit card business, and what could happen if we hit a recession or elevated unemployment and consumers have trouble paying their bills. Beyond the financial sector, General Motors looks extremely attractive to me right now. It's a company that I really love their leadership and things like that. And I think the fears of the long-term implications of the current strike are a little overblown at this point. I don't want to get into the rabbit hole on my thesis on GM right now. I've done videos on that. And finally, I think the home builders in Buffett's portfolio are starting to look a little more attractive as they've pulled back from recent levels. Lennar is one in particular. It trades for about 8 times forward earnings, and it's pulled back considerably from where it was a few weeks ago. But having said all that, the one Berkshire stock I would consider buying more of right now, I already own some of it, is Ally Financial. It's trading for a sharp discount to its book value, about 30% below book right now, I believe. And its business is doing well. Obviously, the auto lending business, which is Ally's specialty, isn't as robust as it was in 2021 or 2022 when interest rates were still pretty low, and the average new car was selling for something like $10,000 over list price because there weren't any. That's not the case necessarily anymore. We've seen the auto market return to some sense of normalcy, but Ally's business still looks pretty attractive. There's a big fear that consumer default rates are going to start ticking upward. And to be fair, there's some good logic to that. Number one, during the height of the COVID pandemic, it was pretty easy to postpone payment on a bill if you were having trouble paying. That's not the case anymore. But we're seeing these default levels more revert back to pre-COVID norms than we are seeing them spike higher. Like default rates are nowhere near where they were in the wake of the financial crisis, for example. The stock's about 30% below its recent highs, yields nearly 5%, and trades for less than 8 times forward earnings, despite being a very profitable business. Management has a great track record of shareholder-friendly decisions like buying back stock. Ally's bought back a ton of its outstanding shares over the past few years. It's pumping the brakes on that right now because of all the uncertainty, but that will definitely be a part of the strategy going forward. And there's a lot of room to grow in the online banking space. Consumers want higher yield. And Ally has high yield savings accounts, online checking accounts that you don't ever have to go to a bank to have a checking account, and a full range of financial products. They have a brokerage division. They have a robo-advisor. They have a credit card. There's a lot. So I think Ally has a bright future ahead of it and is trading for a rock bottom valuation. I've bought the stock several times in the past couple of years and think I am going to continue to build my position. Tyler, what are you watching? I know you always have some less mainstream stocks to talk about, so I have to assume that's the case here.
I'm going to go a little contrarian here because I go up and down the Berkshire portfolio, and today there's not a whole lot of things that I'm super jazzed about buying in the portfolio itself. I mean, like I've mentioned it before, I'm not the best banking analyst, but rising interest rates does seem like it's going to be a drag on net interest margins for a little while. So maybe the banks are justifiably treat. I'm not huge on consumer goods like Kraft Heinz, Coca-Cola. They kind of seem a little sclerotic in terms of what you're going to get out of them over the coming years. There's a lot of media companies in there. I can't say I'm super jazzed to be owning media companies right now either, just in general, because media has never, in my opinion, it's never been a great business to invest in, period. And, the couple of oil and gas investments that he has are kind of expensive. So I'm not itching to buy those either. So up and down the list I went. The one that I kind of started circling as I started ticking things off in the portfolio, the one that I actually looked and I could see myself acquiring right now, and that's Aon PLC. It's an insurance broker, global insurance broker, mostly to small and medium businesses. A lot of what they do is kind of like specialty insurance. So say you're a business coming to an Aon with a unique business risk that they want you want to insure against, that they don't necessarily have a lot of custom, or that there's not a lot of like standard insurance coverage for this sort of thing. Your property and casualty insurance or your auto insurance, those are pretty plug and play things that you can go to Geico, you can go to Progressive or any of the other major insurers to get. But when you start to get into weird or obscure sort of insuring sort of situations, that's when you go to a broker like an Aon, like a Arthur J. Gallagher or a Brown and Brown, companies like that have been in Brown and Brown, yeah. So you go to these companies and they will help create a type of insurance product that will make sense for you, and then find an insurer, whether that be a reinsurer or a specialty casualty or somebody that will actually write that contract. And so, but unlike, a lot of what Berkshire Hathaway does in its wholly owned portfolio with Geico and the reinsurance businesses, Indemnity International, for example, these brokers don't actually hold the premiums. They don't hold the float. What they do is they broker this out to somebody else. They can hold some funds as a fiduciary for, the clients pay them and they'll get some servicing fees or something like that. But they're not on the hook, I guess, if you will, for the liabilities if the insurance contract actually needs to get paid out. So it's very much a sales commission fee, services fee kind of business, very high margin. And, insurance for the most part is a pretty stable business. In terms of the actual writing of contracts, you can go through some periods of fluctuation in terms of premiums, in terms of payout rates, loss ratios. But for the broker themselves, that's less of an issue. It's more just service consultancy, trying to get those people in the door and solving the problem that they have. And that's something that Aon has done rather spectacularly for a long time. And in the kind of, we'll call it in the sense of a Warren Buffett kind of company, this is one that does a spectacular job of buying back stock, really returning capital to shareholders. Over the past 10 years, they went from 311 million shares outstanding down to 207. So we're talking a little bit more than a third of total shares outstanding have been retired from this business over the past 10 years. Things like that are going to be accretive to the bottom line, to the investor, and that sort of thing that you want to see. At 21 times earnings, it's not the cheapest thing. And if there was one thing that would, make me hesitant to actually acquire Aon, it would be the price right now. But relative to what else I'm seeing in the Berkshire Hathaway portfolio today, that is the one that makes the most sense to me.
Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by The Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.